Hello and good evening everyone. I am Abhijit and welcome to a new episode of Investing Fool where we discuss about DIY momentum investing. Hope all of you are doing well. Hope all of your portfolios are also holding up well in this market condition. So in today's video we'll talk about a couple of minor additions that we have done in not addition of stocks, so a couple of like minor changes that we have done on the portfolio sheet. So we'll talk about them and then we will talk a little bit about how individual stocks and sectors are doing in recent days. So we'll be going for the next rebalancing in the next 5 days. So yeah, we'll see how the stocks and sectors are shaping up before it. And so today's video will be very short. I'll try to keep it within like 10 to 12 minutes, and there will be no slide. And because there is no slide, I'm just explicitly mentioning before we move on to anything else that none of this should be construed as financial advice. So please consult your financial advisor before making any investments. Whatever stocks, indices, whatever we are talking about on these videos is just for education and illustration purposes only. With that said, let's begin with a look at the portfolio. And the first change that I wanted to share is that you can see this column, right? So we have added a new column for PE ratio, and we are pulling the PE ratio of these stocks from Google Finance. So basically you just give the ticker name and the attribute as PE, and you pull the PE value of the stocks on Google Sheet. And while we have added the individual PE of all the constituent stocks of the portfolio, we have also added, if you can see here below the portfolio advance decline ratio, we have added the portfolio price to earnings multiple, right? So that is basically a weighted average of the PE ratio of individual stocks with the weight, with their current weight in the portfolio, and their current weight is based on their current valuation, not the weight with which they initially came in the portfolio, right? So that gives us the portfolio level price to earnings. So first of all, like most of you would be aware of what PE ratio is. Practically everyone in the market keeps talking about PE ratio. It's a very common valuation metric that is used by a lot of market participants, specifically fundamental and value investors, to gauge the valuation of stocks, right? It's basically the current market price of the stock divided by the EPS. But when we talk about PE ratio, there is no blanket criteria as to like that even fundamental investors use, that you should not buy above this PE or you should buy below this PE or whatever. But when we it depends on a lot of factors, right? It depends on industry. It can depend on the nature of business that the company is in, what other what kind of merit, what kind of PE the other players are getting in that same sector. So a lot of factors are there, and I'm not an expert on PE. So and the other thing is that why we are not using the PE ratio or any valuation metric per se while making our entry or exit decisions. It's not part of our strategy, right? So any momentum strategy you would see, typically we would be buying based on the price action, right? We are not we are not considering valuation at all. So then why have I added the PE ratio of the stocks in our portfolio? So a couple of reasons. Like first is there are a lot of metrics that we may not be actively using as our entry or exit signals, but we tend to be curious about them, tend to want to know them, right? Be it for benchmarking, be it for anything else, right? For example, the market cap column here, right? Although this market cap value is being used to know whether, like, to categorize stocks as large, mid or small on this sheet, but even then, even if I'm not using the market cap, like my momentum strategy is independent of market cap, right? Whether it's large, small, mid, we don't care, right? As long as it's performing, as long as it's in the momentum ranking, we'll buy it, right? So but even then I would be very much interested personally to know the market cap of different stocks in the portfolio. It gives me a context, right? just like I would be like, even the sector doesn't matter in any way, right? I would still like to know like how much of my portfolio is in like consumer versus I don't know, banking or something else. There is no banking stock anyway, but so just as an example. So similarly, PE ratio is a very common valuation metric that I may not use for my entries or exits or any part of the strategy. Basically, I may not base any decisions on it, but I would be curious to know what kind of price to earning multiples the stocks in my portfolio are getting, and what is the price to earnings multiple of the portfolio as a whole. So that's the first thing. So there are many allied metrics that we do not use. We're just curious about them, so we do that. So we take a look at that, and the second reason could be that in the long term you could use this again, not for investment decisions per se, but you could like use this to get a better understanding of how the PE or like this valuation for your portfolio is trending vis-a-vis something else, right? For example, you can take the Nifty 50 P or some other benchmark P, and you can compare month on month. Even I could do that. I haven't like given a final thought on that, but let's say you take the PE as the at the closing day of every month, right? You record it out, and then you see like how the portfolio, like your portfolio price to earnings is behaving compared to some other benchmark that you're taking, right? So that could be an interesting thing to observe that pattern. So that could be another reason, right? So this is why I have added the portfolio price to earnings ratio here. And while we are on this topic, let's see how the different individual stocks are performing, not performing, but how their price to earnings multiples are structured. So if you can see here, so Trent has a price to earnings of like 150, Zomato at 400, Inox Wind at 440, Kalyan at 107, Dixon at 174. So there are many stocks, right, which have very high like P multiples. So if you apply a fundamental investing lens on these stocks, you would never be able to buy these stocks, because you need some valuation comfort, you need some margin of safety as a value investor or a fundamental investor if you do this. But as a momentum investor, first of all, we do not we do not care about the market cap. Similarly, we do not care about the P ratio of the companies as well. While we do not care about the P ratio, it is important to understand why our portfolios have such high Ps. And if you compute the same for your momentum portfolio also, it would be pretty high. The first thing that we need to understand is the market moves in different cycles, right? And there are cycles of PE expansion and contraction as well. So if like in a liquidity infused bull rally like we're having right now, monthly SIPs are coming in, fund managers do not have anywhere to deploy that money, so they will keep buying the same stocks, the stock prices go up. So the earnings improvement is not a lot, but the price improvement, the price rally is too much, right? So the natural consequence of that is that the P ratio would go up and up and up, right? So many stocks, so because as a momentum investor, we are taking stocks whose prices have moved very high, right? So we are not basing our investing on what is the like what is the intrinsic valuation and what is the current valuation and what is the delta, and I could make some gain there. We are not doing that, right? We are basing it on the momentum anomaly. So the momentum anomaly is basically that whatever has performed in the past, let's say in the 1 year, there is a very high likelihood that it will perform in the immediate short term. It will continue to perform in the immediate short term as well, right? So we are just basing our investments on that anomaly, that observed anomaly. So I just forgot what I was speaking about. So anyway, so yeah, so when we take stocks, when we take stocks in our portfolio, it's usually because their prices have rallied too much, right? If their prices have rallied too much and the earnings have not kept pace, which is usually the case in these kind of bull runs, then naturally a lot of those stocks would have a very high PE multiples, right? And you can always look at, like you can always hear some participants saying कि 30 के ऊपर का PE मत लो, 100 के ऊपर का PE मत लो, whatever. Like although in this market you would hardly get any stocks with 30 PE and performing very like amazing, but actually that's the case for some of the stocks, right? And if there, as I said in the beginning of this video, there are no standard benchmarks. Similarly, in momentum portfolios also, it's not the case that every stock will have a very high P ratio, right? Some of the stocks have performed really well. They could still have lower P ratios because of like the industry they're in. For example, if you see Oil India here, so the PE would be still 14, right? It's still 14. You can look at a lot of PSUs which like had P's of maybe like 7, 8, and even after such huge bull runs, like even many of these stocks like PFC, REC, they would still have PEs that are much lower than many other companies, many other sector companies. Like for example, consumer stocks would typically command a higher PE. While we are talking about PE, another thing to mention is that sometimes you would not get the P ratio like using this formula. For example, here you can see, and it's not the problem of the formula per se. You can see for Glenmark, we are not getting the PE, right? Obviously, it has a current market price, so there is some issue with the earnings of the company, because of which you are not able to generate or pull the P ratio for that stock. So this formula actually negates this. So whatever wherever we are not getting a number, it basically like bypasses that value, right? It ignores that value, and it takes the other values to compute the total. So even if you go to screener, right, I just opened the page for Glenmark, you can see there is no stock PE here, right? So it's empty here also. Anyway, that was the first change that we have done on the portfolio sheet, and so many of you have reached out to me via email requesting for a copy of this sheet, and I've shared a, a duplicate version of this file also, that you can then create a copy of and then edit as per your requirements. But there are many minor changes which I've done in the past few weeks. I have not updated those changes in that duplicate file, so I'm aiming to do that within the end of this week, and you can update if needed from that link as well. Okay. Anyway, so that's the first change that we have done on the portfolio. If we take a look at sectors, there is another minor change that we have done. So earlier we had like 1 week change, 1 month change here for different sectoral indices, for broader market indices, and then straight away 1 year, 3 year, and 5 years. So we have included 3 month and 6 month changes here as well. It's a very minor change, but it gives you a more granular view of how stocks are performing in the current times, right? So you can see here, although like on a 6-month basis, pharma has outperformed IT quite a bit. So if you look in the recent past, pharma and IT have done very well, along with maybe consumption. Other stocks have not done so well, specifically like PSU Bank and all that, they've not done well. But if you see pharma 6 months, so it's at 21% versus IT 6 months, which is at 15%, right? But on a 1 month basis, IT has really surged ahead of pharma, and almost double the returns of pharma, right? So these are the subtle kind of trends that you can see while we have added these 3 month and 6 month change metrics as well on the sheet. Okay, so that was the second change. Now let's just take a look at what the individual stocks in the portfolio are doing, and let's take a look at the last 10 days performance. Okay, so if we take a look at the last 10 days performance, most of the stocks have done nothing, as is usually the case. One stock, this is Godfrey Philip, had gone up quite a bit, and then it came down quite a bit. At the end, it did nothing. And if we look at these stocks, so this is Zomato. So Zomato is the one that is outperforming when we look at the last 10 days. and Inox Wind. So Inox Wind and Zomato have done really well over the last 10 days. I mean, not really well, but compared to the other stocks which haven't done practically anything, right? And the one stock that has disappointed us quite a bit is Oil India, right? And Oil India we had discussed in the past, in the previous video as well, because of the ongoing pressure on crude prices globally, that has hit Oil India quite a bit. And you can see the chart here. You can see we bought somewhere around, I think we bought somewhere around here. I'm not sure what the current gain percentage on Oil India is. Must be around 0% or slightly negative. Okay, it's minus 6% actually. So we bought at 620. So yeah, we bought right here at the top. We started going down, and then again it in this channel it went up. That momentum again continued, but because of the kind of trajectory global crude prices have shown in the past few sessions, Oil India stock has plummeted quite a bit. It has practically erased all of the gains and gone back in negative. But the momentum ranking of this stock still continues to be high. I think it's still in the top 5 or top 10 in the momentum rankings. But if it continues to fall like this sharply, the ranking will change pretty quickly as well. So yeah, when we talk about today's performance, the Nifty 500, which was our benchmark, was down 0.5%. We were up 0.5% because of some stocks performing. The largest gainer was Bajaj Auto, and it went up by 4% today. Zomato, Kalyan, Dixon, Cummins India were the other performers. In terms of laggards, Oil India, as we discussed, was a huge laggard, and HAL was also down. Motherson was down close to 3%. In terms of the market, if we see, if we look at the broader indices, right? So Nifty 50 was down. So almost all these, these 4 major indices, right? Nifty 50, Nifty Next 50, 200 and 500, almost all of them were down 0.5%. And if we look at the daily chart of Nifty, actually the market was holding up pretty well for almost till like 1 p.m. It was holding up pretty good. It was growing like solidly, and our portfolio, like on a 1 day basis, our portfolio gain was almost like at 1.1%. And then the market started falling. Again, there is no reason. It recovered in the fag end of the session, but there was a heavy slide, downslide for the broader indices, and our portfolio also erased much of the gains that it had made today, and closed at 0.55% up. One important thing that I wanted to share is if you can look at the gains of HAL and Bajaj Auto, right? So HAL and Bajaj Auto came into the portfolio on the same day. And if you had asked me while buying these two stocks, given their trajectories, that do you expect both of them to give the same kind of performance in the same time period, I would have said no, right? And the trajectory of stocks in your portfolio will vary quite a bit. You would never know. Momentum has a very good way of throwing up surprises for you all the time. So if so HAL, which had reached almost like 80% gain, has erased much of those gains. Defense stocks have not been performing very well in the recent few months, and HAL is down to like 53.7%, and Bajaj Auto, it like climbed slowly. It didn't run as fast as HAL and then fall down. It just keeps climbing slowly and slowly and slowly, and it has practically beaten HAL if you look at the returns from the mid of Jan 2024, right? And I would not have expected this, and that's why like when many people ask these questions that should I buy more of something that I have more conviction on, I typically answer no, right? Because you do not know what will perform going forward, what would not perform going forward. So if you have an equivate strategy, like we have an equivate strategy, So I will just allocate equally when I'm entering a batch of stocks. And if you have some other way of allocating, right? So if it's market cap weighted or if it's risk weighted or anything, so you just need to follow your strategy. Do not have any discretionary way of like allocating more to one stock versus other, because you do not know what will perform going forward. Maybe the one where you put your bet will not perform, and the one where you bought or purchased less units, that might give you a positive surprise, right? So a good way to avoid discretion is to just stick to your strategy of whatever way you are allocating stocks, you are allocating weights to stocks. And yeah, so that's something that I wanted to point out. In case of if we look at some other stocks, right? So Zomato and all these stocks had performed really well midday, but they had slid down by the end of the day. But Zomato is one stock that has again come pretty close, like it is almost at its all-time high, right? And it is going very strong. So some sort of minor corrections always come, but it is kind of a stock that is just not losing momentum. Um, so yeah, it's good to see it continue to perform, and let's see how the trend continues in the future. uh, if you haven't if you are watching this video for the first time, please note that we have been tracking this portfolio for around 9 months now. This portfolio sheet, everything, all this is live, and you can access it anytime. We communicate whatever we buy, when we sell, all those updates you can find in our videos. If you haven't subscribed to this channel, please consider subscribing to this channel. And that's pretty much it for today. So have a good day, and I'll see you in the next video. Till then, take care. Bye bye.